Ben, all right, so give me your top-down take here on this result this morning. We've had some time to process it and think about it. What's your conclusion?
Hey, Oliver. My conclusion is that it is a positive report because it did show components in there where there was a significant rebound in hiring, right? Leisure was the one that stood out. But I also look at the labor force participation rates that were shifting higher, as well as the employment to population ratios. Those also moved higher, and hours worked. So there's productivity gains. And I thought was interesting, too, is that if you really drill into that BLS report, you can find data on, people that are for some reason unemployed, that this sort of classification, that those who are unemployed specifically for COVID, that number dropped quite a bit over last month, so almost like 800,000. That probably indicates that people got vaccinations and went out back to work. So it does tell me the reopening is really in play, and that's what happened in the market today. When that report came out, you had a knee-jerk happen in the Treasury market and in futures, but you really saw actually when the session opened that the reopening stocks were to start to fly, right? And I think this is what this report says. It's a strong jobs reopening report.
Ben, did the market kind of show its true colors this morning as soon as we got a bad report and bonds rally and the Nasdaq just surges? Because to your point here and what we've been talking about is the leadership has emerged more in the cyclical stocks throughout the day. Nasdaq's still up, but who knows? Maybe we should give it a couple days. The bond market has faded pretty quickly. If the Nasdaq is so tied to bonds the way it looked like this morning, and we can think that the recovery is going to continue, is this a short opportunity, a percent bump that can be faded in those growth companies?
I won't entirely fade those growth companies, to be honest, because there's a group of them that are like more, let's say, mature technology companies that are very much part, I think, of the recovery. Think of the mainframe companies like IBM as one example. And it's done so extremely well over the last period. But I think people look at that technology seeing like, well, you got a recovery, you do need that sort of technology to be working. It's more maybe that stay-at-home technology play that if that rebounded again today, then there maybe be an opportunity to fade out of that. I think the knee-jerk reaction, by the way, between the Treasury market and how the Nasdaq futures responded to the jobs report, it does tell you the connection between yields and tech remains strong, but the correlation started a bit break down, meaning if yields go down, tech stocks are maybe somewhat settling out here at this point, maybe in part because the Treasury market really gives us a message, not so much about, oh, this was a really bad report and we're going to get disinflation. It's more saying that the U.S. economy is really hot, and that hot nature of the economy starts to a bit cool down from here, meaning in the next month or so, there's a few other data points that may show some surprise downsides, as in more like a cool down. I think that's what Treasury yields were saying today.
Ben, so when we look at this and think about the fade in bonds today, you're looking at the real yield chart here and the butterfly spread 5 and 30 years. That's the dark line. The 5-year the 5-year real yield is the one in brown that has reversed quite substantially. If we're fading this move in bonds today, are we at the bottom in that real yield at this moment?
We could be hitting a bit of a bottom there. I mean, at the end of the day, the real yield decline, which is notable, is ultimately about the inflation story. Right? There is an expectation, given all the commodity movement that we're seeing, that headline inflation probably next week something like 3.5% to 3.8%, somewhere in that range. So real yields with nominal yields rate is low should actually be more negative. I think that's what that 5-year real yield is showing, that move down. But at the same time, the bond market has somewhat of a particular way of pricing growth, and that's that butterfly spread talks about. That's the difference between the 5-year yield and, say, a T-bill and a 30-year yield. It really gives you an idea of what markets think about growth going from here. The 5-year tends to be more closely linked to expectations about growth. So if the yield in the 5-year is lower than what the 30-year T-bill combined is, that's telling you the market, in the Treasury market at least, there's an expectation that growth, it may not have peaked, but it certainly could cool down, as I mentioned. At the same time, we have inflation, right? And we will be in a year now of well above 2% inflation, if not closer to 3.5% inflation. That's what that real yield says.
Ben, thinking about how this informs the Fed and the nature of policy, obviously the last couple of weeks we've been considering the taper possibility, more chatter building in that. Does that completely put this off the table? I know you're looking at a chart of employment to population ratio, which has become kind of the buzzword for what the Fed might be looking at to gauge the status of our recovery.
Yeah, the employment population ratio is definitely important to watch because that does tell you about the broader inclusive growth in the labor market, right? And that's what they're talking about. The more that employment ratio improves, employment to population ratio improves, the more broader the recovery in the labor market is. And, not all sectors are going along just with that yet, right? And therefore, there's more room to go here. And that has been their message. And if you listen to Kaskari this morning in the interview, he basically said, this jobs report completely vindicates our position as we are right now. We must see the job recovery really take hold. We must really see employment improve first before we do anything. And I think this is why the market has listened very closely to that already prior to this interview, listened to the Fed's message and said, there's not going to be any tightening for the next 2 years at least. And tapering will really be something of, they can only do that when they actually have the evidence. So, yes, the tapering discussion was maybe a little bit premature in the mind earlier in March when people looked at that a lot, and has now really faded out of the Treasury market.
Ben, the idea that this report validates the stance of the Fed to wait for hard employment data, I mean, part of me is is it not the opposite? Because what they're doing is relying more than ever on employment data, but more than ever, our employment data does not reflect what's actually happening, right? Because if I might not have a job right now, there are people who don't have jobs, but the money that they have is greater than what it was a year ago. So look, I don't have the economic chops to understand if that's preventing them from finding a job, but I do have the chops to look at the number. The data that's published, the personal income is higher for everyone, almost everyone, over the past year. Whether you made money trading stocks, whether you made money because you're rich and you got richer, or if your supplement from the government was more than what you made. The personal income is up. So employment is down, incomes are up. Why are they relying more on the employment data?
I think what they want to see, Oliver, with that is that the more people come back into the labor force and find work, and they have an income that is indeed at the same level of pre-pandemic or perhaps higher, an even better position that these people are in when they are starting making more wages as we go from here. And I think this is where the market is waiting for, okay, if you give us that time, that runway of when that employment, maximum unemployment really happens, with all this money that's already been made, then you get the real torque there, right? And then really we should see a normalization of interest rates. So, but to your point, the economy is already accelerating. It may get a little bit too hot and it may cool down a little bit, but that's not a slowdown. It's going to continue to strengthen, particularly because of that income data and the savings that's also on the sidelines, part of that income. So I do think that at some point this discussion on tapering will come back again. When that exactly will be, we'll see, but I think it will come back sooner because obviously, as you mentioned, there's a lot of sideline pent-up demand sitting there that's about to be unleashed. And as we do reopen, which is happening, it will be unleashed. So the economy will continue to strengthen. Therefore, you cannot really stay sidelined as a central bank too long, for that matter.
Ben, just to summarize this, is it a mistake to think that this report killed the inflation conversation? Because I kind of see a murmur of that in the dialogue today that, oh, you guys are worried about inflation? Well, look at this bad report. Is that the way we should be interpreting this?
I wouldn't interpret it that way because, first of all, the average hourly earnings did see good uptrend in a lot of categories, including in leisure. That's very encouraging, right, that people start to make more money. So there will be, as a result from that, prices will be affected by it. Secondly, we are, and we cannot deny this, we are in a commodity boom, so that is affecting prices in general. And we're not in a situation where we're going to go from maybe a hot economy to cool economy of a contract, and we're going to get disinflation. So no, this report did not kill the inflation discussion. If anything, the market, I think, is priced for next week's CPI pretty much. If anything comes a bit higher than that was anticipated in that particular report next week, the inflation discussion will be really alive. So I think we should stay on alert on inflation, that it's here, it is higher than what we've had experience of the last 5 years. And it's a question now of how it stays here with that transitory effect that doesn't really fade out a transitory effect, people are going to become more and more aware of that we have indeed an inflation environment of 2.5%, 3% more stickier than we thought.